Okay, and then the last problem that I'm going to do with you here is problem 2-1A, found on page 96. And the instructions are this architect organized this company, and during the month, they had the following transactions, A through N. And then number 1, it says record these transactions in the T accounts. Number 2, determine those balances in the T accounts. And then ultimately we get to number 3, prepare an unadjusted trial balance. So what we're going to do here is just walk through these. And ultimately you get to the end where you got to get a balance, right? So accounts receivable, there's only one transaction, so there's your balance. Same with supplies. Accounts payable, it had 2 credits, a debit, and finally a credit balance of $9,500. So if there would be one thing that you could do different with that problem would be, let's just read letter A, issued common stock for 30 grand. So you first would have debited cash for $30,000 and then common stock for $30,000, and from this you would put the debit there and you would put the credit, if I can find, here it is, common stock for $30,000. So I think it's really a 2-step approach. You eliminate the journal entry by just putting it straight to the T account, but ideally you would do this first and then you would post them to the T accounts second. So that was letter A. B, paid rent, so debit rent expense and credit cash. Purchased an automobile, $28,500, paying $6,000 down and giving a note for the remainder. So we put the entire cost of the automobile there, $28,500. However, $6,000 was paid with cash, and then the rest of it was in a note, which is just like an accounts payable. But a notes payable is something a little bit more long-term. Accounts payable is short-term. Purchased office equipment and computer equipment on account, so you would debit those asset accounts and credit accounts payable. Paid cash for supplies, so you debit supplies, credit cash. Paid cash for insurance policies, so they credited cash and then they debited, and this is a new account that we haven't talked much about, prepaid insurance. Why do we do prepaid insurance? The difference is, for individuals, when you buy insurance, you buy it by the month. You pay for it usually by the month. But companies, they require to have the 12 or the 6 months up front. And then you basically have an asset. You removed cash, but now you have a prepaid insurance. And the reason it's prepaid is, let's say we bought a 12-month insurance policy on a building, January 1st, all 12 grand. So essentially, we're going to have $1,000 worth of insurance expense each month. Then in March, we sell the building effective March 31st. Despite the fact that we paid 12 grand up front for all 12 months insurance, we will only own the building for 3 months. Therefore, we would get a refund back from the insurance company on the 9 months that we will never insure the building. So then in that case, you would debit cash and we would credit prepaid insurance because the insurance company would return the unused portion. Letter G, received cash from clients on plans delivered. So letter G, you're going to debit cash for $9,000 and you're going to credit some kind of revenue for $9,000. Paid cash for miscellaneous expense, debit miscellaneous expense, credit cash. Paid cash to creditors on account, $4,000. So here we go, we credit $4,000 to cash, but there's a debit to accounts payable for $4,000. It's reducing accounts payable. Paid an installment on the notes payable, $1,875. Credit cash for $1,875. However, the notes payable is also going to go down by $1,875. Received an invoice for blueprint services due in February, so we are going to debit blueprint expense for $5,500. However, we still owe it, so accounts payable is going to be credited for $5,500. Then, recorded fees earned on plans delivered, payment to get in February. So there's an AR for $31,400, but there is fees for $31,400. Paid salary of assistants, debit salary expense for $6,000 and credit cash. Paid gas, oil, and repairs on automobile for $1,300. Again, debit to automobile expense and a credit to cash. These are good journal entries to review, but here we go. We got them all recorded now also in the T accounts. Add up all the balances, and that brings you to number 3 of the problem. You produce the trial balance. Again, there's 2 parts to it. It shows all of the accounts that we use in this company, as well as that our debits equal our credits. It also asks here, determine net income or loss. Well, again, net income or loss is all of our income statement accounts, revenues and expenses. So it's essentially the net of those. 40 less all of those expenses gives us a net income of $22,500. That takes care of our exercises and problems for Chapter 2. Again, I would take the time to go through Cengage and look at those exercises and make sure that you've had time to let that material sink in.